Hey everybody, it's Brian Shannon from alphatrends.net. Today's Friday, the 1st of February 2019. Hopefully you had a good week of trading. The market certainly continued to rally here, green in all of these markets. So let's take a look at the charts and make some sense of it. When we look at charts, a lot of times people look at a line on a chart or something that they've drawn in and they say that is resistance. As I've said numerous times over the last several weeks, we've been looking at potential levels of resistance, an area that would be offered enough supply to slow down the demand that's currently driving prices higher. Today, we find ourselves at another one of those levels. That is the volume weighted average price from the beginning of 2018. That purple volume weighted average price was pretty important last year. Here we are at it once again. We also see the 200-day moving average overhead. And if we kind of clear this off a little bit and zoom in, you can see if we take a look at from the all-time high down to the low that we saw in December, we also are at a 61.8% retracement. Now, there's nothing here that says the market has to stop at this level. Instead, we look at it and say we're at a potential level of resistance. So we do what we've done with all of these other potential levels of resistance. And that means we look to a shorter term time frame to see if the market is giving us indication that there is any actual supply to slow this market down. Now, this chart is 65 minutes. Each one of these candles represents an equal 65-minute period because that gives us 6 equal candles per day rather than using an hourly chart which would have one 30-minute candle and 6 60-minute candles. On here, I've got a volume weighted average price year to date and the volume weighted average price from the December 24th low that did act as support twice early this year. And we're still obviously seeing money flow into this market as the average price paid in the S&P 500 is now at about 251. We also see this 5-day moving average. Now, what we looked at last week was that if we were to break below this level and create a lower low below that 5-day moving average, which was starting to turn lower, then it would have set us up most likely for a test of that VWAP. Instead, we were on caution in this area, but we did not get bearish. What happens is if you get bearish too quickly, the market gaps up and runs away from you. Instead, you want to wait for price confirmation. So you can talk about resistance levels until you're blue in the face, but until the market actually finds a level where it finds resistance and then turns to a pattern of lower highs and lower lows, it's just a potential level. It's an area to be interested in. We want to anticipate all potential scenarios and wait for price confirmation before we actually get involved. So next week, we're going to continue to give the benefit of the doubt to the buyers as long as we remain above that rising 5-day moving average. If we start to see the 5-day moving average flatten out and then turn lower, then we will become much more cautious and look for a pullback. But until that happens, we still have the possibility that this market could run for the 200-day moving average. Maybe it runs right through there and just continues to go higher. No one has a crystal ball that works. People have crystal balls that they say work and then I told you so, but the fact is we don't know until after the fact whether something was support or resistance. So we give the benefit of the doubt to the intermediate term trend. That's the time frame I choose to focus on and analyze because these bigger picture trends don't always make sense. And if you can make sense on the shorter term time frames, that becomes your edge. The NASDAQ lost a little bit of ground here today, but you can see we broke beyond some resistance earlier this week at 165.5, and that we are still well above that. So we have to give the benefit of the doubt to the buyers in here as well. Now, this market is back above the volume weighted average price from the peak. If we take a look at the Fibonacci here, you can see it's not nearly as strong a bounce, not yet at least, but it's interesting that the 61.8% retracement comes together with the 200-day moving average. So perhaps this market has the power to continue up towards there. Our first warning sign that it won't do that would be if it was to break down below and hold below this level. If it was to be a failed breakout here, then I think we would really have to put our guard up and look for maybe the possibility that then that 5-day moving average flattens out and begins to turn lower, perhaps down into this area. We're certainly in a condition where it's been up a lot, it seems unbelievable, etc., but there's no evidence, again, that sellers are gaining any control. And same is true for the Russell 2000, which is up against its volume weighted average price off the peak, and that's a potential level of resistance. But keep in mind, where have we come from? We've got that 50-day moving average starting to flatten out. If we pull back, I think 144 is probably about as bad as this market gets before we determine whether or not there's something much more significant for the market, and that's not a call. We have to look and think in steps and say, as long as the market is above this rising 5-day moving average, we'll continue to give it the benefit of the doubt to the buyers. We're not going to try to sell short unless, of course, you're some kind of super short-term scalper. The semiconductors also continued higher this week. They have the potential maybe of making it up towards that 200-day moving average, up near the 100 level, and perhaps it's gravitating towards that round number of 100. But we don't want to bet against it. We've seen so far that the year-to-date volume-weighted average price has found buyers 3 separate occasions here on pullbacks in the semiconductors. So there is order in this market. Even though it's choppy, there is order. Now we're getting a little bit extended on the near term, so be aware of that. A pullback towards the 5-day moving average down at 96 wouldn't come as a surprise, and it wouldn't really harm this intermediate term trend either. Biotechs continue to be right up against this little band of resistance that we've seen in the past, and now it's continuing to hold for now as an area of supply. That's also the 200-day moving average. Maybe the market just continues higher and then does something like this. We simply don't know. But to bet against it just because it's at a level where sellers previously resided, unless there's a risk reward that you can justify in the short-term time frame, it doesn't make sense to fight that intermediate term trend. The financials were up 11 pennies today. This market is holding really strong as well. We've been, this week in a pretty tight range here that we can define like that. And I think if we get below $25.70 next week, then it's likely we come down towards this 25.30 level, and then perhaps we come down a little bit further to the year-to-date volume-weighted average price. But there's no evidence that the sellers are gaining control. We will know if it breaks down. Then maybe you can get short. But the fact is, the intermediate term trend remains higher, and fight it at your own peril.